subject to means I buy Quinton's home. Quinton stays as the guarantor for that loan, but the property does transfer to me. Notice I didn't say I assumed it. I didn't apply for it, because assume implies that you applied for the loan, and you
Correct.
have to. It's just like getting your own loan.
Right.
So we're just averse to going on any personal guarantees. So the subject to settlement statement looks the same. Everything on both sides, the buyer and seller statement, looks similar to a conventional deal. The difference is, instead of new money, it simply says subject to existing loan with the bank name and the exact balance at the time of the closing that you're taking over. Now, taking over means you're just making payments. It stays in the seller's name.
Okay.
This is critical for personal guarantee reasons.
Welcome back to the What's Your More podcast. I'm your host, Quinton Harris, and I am joined today by a second repeat guest. I am glad and honored to have on the show, Chris Prefontaine. Welcome to the show, my friend.
Thank you. Thanks for having me back.
Yeah, man, it's great. You're back by popular demand. I mean, we came to episode 79 and talked a lot about subject to and the triple payday, and we were really trying to explain the differences on that show between these rising rates and the opportunities to do subject to. So for those that didn't get a chance to tune into episode 79, we're going to break that down in definite more detail today, a little bit slower. Many of our audience fans came back and said, hey, can you elaborate on some of these things? You guys had a lot of value there, but man, you went through it in like 32 minutes. So we're going to do a deeper dive on that today. And for those that didn't get a chance to listen to episode 79, just to bring you up to speed, Chris has been in this real estate industry for over 31 years. He's the chairman and founder of Smart Real Estate Coach and a 4-time best-selling author. He's a Forbes Business Council member and a 3 times Inc. 5000 honoree for fastest growing companies, focusing on transferring W-2 employees into creative financing in real estate for investors, with over 100 million in transactions completed. He also hosts one of the global top 0.5% ranked podcasts in the world, and it's a great podcast, Smart Real Estate Coaching. If you get a chance, check that out. There's tremendous value, and well over 4 years worth of episodes on there. They have been doing this for quite some time. Chris, seasoned vet, welcome to the show. Glad to have you here today.
Thanks. I look forward to diving in, buddy.
Yeah, absolutely. So, last time we were on here, we really talked a lot about this this notion of subject to, or sub to is what we're going to call it for our audience. Chris and I go a little fast, as warned from the precursor here, but sub to means subject to. So let's start with that, because last time I think that was something that was really eye-opening for many of our audience members. And I myself went to a commercial property following the show, and I started tackling that same concept. And I think the biggest hurdle I found is probably what our audience found. Most people don't know what we're talking about. So therefore, it makes that transaction more difficult than it should be.
Yeah. And by the way, let me comment on that. Some states, Quinton, are more, you can do this anywhere, but some states just are more prone to do a lot of them. So a lot of the attorneys are privy to it. That's all. And so so even some sellers in some states, we'll talk about that.
Great.
So you want to go back to the very bare basics, correct?
Let's break it down. Listen, we got audiences that range, in our audience group of over 5,000 listeners, I got people that range from pure real estate investors to real estate agents to mortgage lenders. And then I've got the average Joe that wants to learn more. We're in that education platform like yourself. So this is where they really, really appreciate the deep dive.
Okay. So just so they don't feel bad, that they don't know it too, I'm going to preface it with this. My son, Zach, who may have been on your show, I don't know if he's been on yet, son-in-law, sorry. He's my partner and CEO. He was speaking at the MLS event last week for the soccer players. Okay. They invited us in to show them how to transition into business. Interesting. And my point is this: he had dinner with a very large fund manager that's out gobbling up properties now due to the market. And this fund manager had zero idea what sub to was. Zero. So, and he owns billions of dollars worth of real estate. So that just kind of speaks to our point. It's just not it's not well, I guess, really kind of publicized. That's the biggest thing. It's just not well publicized. So that's great to know. So if you're an audience member, you don't know what subject to is, don't worry, you're not the only one. You're okay.
We're going to jump into this though. So can you break it down for us exactly what we mean by that, and then how we actually approach that for as far as purchase?
So I'll do super basic. So a subject to, let's say you've bought your own home in the past. You will remember then, and if you didn't, I'll phrase it differently for you. But those of you that did, you might remember you had a settlement statement. And on that settlement statement, you got a loan probably. And on that settlement statement, there was a line item. And the line item was loan with, and the bank name you took a loan out with, and the number you took out. Let's say it's $250,000. Well, that new money came to the table and that helped you close that deal. The only difference on a subject to deal, because subject to means I buy Quinton's home. Quinton stays as the guarantor for that loan, but the property does transfer to me. Notice I didn't say I assumed it. I didn't apply for it, because assume implies that you applied for the loan, and you have to. It's just like getting your own loan.
Right.
So we're just averse to going on any personal guarantees. So the subject to settlement statement looks the same. Everything on both sides, the buyer and seller statement, looks similar to a conventional deal. The difference is, instead of new money, it simply says subject to existing loan with the bank name and the exact balance at the time of the closing that you're taking over. Now, taking over means you're just making payments. It stays in the seller's name.
Okay.
This is critical for personal guarantee reasons.
So
that's the definition.
So that's a great definition. So just a couple questions there, deeper dive, because this is a question that I got many times. Why would a seller want to do that, Chris?
Yeah. So there's different, I'll break it down to two, but there's hundreds of categories for sellers, right?
Sure.
One seller might be, we'll talk about this later, free and clear, and they all have no mortgage and they're not stressed financially, but they love doing creative deals for other reasons. This seller, however, is typically more of the avatar of, I need financial relief tomorrow, right?
Right.
I think the best way is always to give examples. We recently had a couple that was getting divorced, not amicable at all. One in one state, one in another, 2 months in arrears on the property, meaning if you're new, that just means they haven't made 2 months worth of mortgage payments. They're in like the zone of, uh-oh, we might get a pre-foreclosure notice.
Yeah, we call that delinquency, then that 60-day delinquency mark.
Yep. And so that they need a financial relief bill, right? So
Correct.
That's typically the seller that'll go, whatever, I just need it fixed. We bought that home, we still own that home, they're gone, we probably never will talk to them, but they are still the guarantors of that loan. There's a good example.
Okay. And so this breeds kind of a lot of what we've been sharing on the show here, because right now delinquencies are up, but equity positions are up. And so that's a big difference from 2009. You got all these people, these, I don't know, influencers, whatever you may call it, on the socials, and they've been preaching for the longest time, hey, we're going to see a market crash, we're going to see a bubble, blah blah blah. But I think the thing that was highly unconsidered there, or given a lot of weight, was the equity position in these homes, which allows you to offer relief in these particular subject to situations. Because if the home was overvalued, for you to offer a subject to would be foolish on your part, as well as the person that owns the home.
I'll tease that a little bit. You're 100% correct. I'll tease the end of that a little bit. If the home is slightly, not grossly, over leveraged, we can still eke out loads, not a little, loads of profit due to what we talked about in the last show, the 3 paydays.
Yeah.
But if it's grossly, someone calls and says, hey, and we get this, have made my payment in 2 years, they basically suck up any equity and then some. We're usually like, you called us just a touch too late.
Yeah, that makes sense. Yeah, no, that makes sense. And, in today's environment, let me ask you this question. Are you seeing the people that you're approaching for these subject twos, are they in the same generation category, or are they all over the place?
That's an interesting question. All over the place.
Okay.
And believe it or not, there's a few recently where one of our guys is just crushing it. He calls it a hybrid deal. He coined it. But what he's doing is he's finding some sellers just in his normal prospecting. He's not seeking them out that have, to your point, equity. They're current, but they may have a second home they need relief from just to move on. And they're willing to wait for their equity as long as it's locked in and taken care of. Okay. So I'm talking like putting a subject to deal together where he took over a loan payments on $100,000, but the guy might have 200 more grand coming in 5 years or whatever they negotiated out. Those deals are more prevalent. So it's not just the people that are in trouble, but they just want some relief, and it could be positive.
Right. And a lot of that creative financing that you call it, which is exactly what it is, a lot of that's to alleviate some tax burdens as well, as we've talked about, for a person that may not be in trouble.
Spread out. Yeah.
Yeah, there's another option for that you don't always have to be in trouble to look for the subject to deal.
There's one more instance actually made me think of that when you said it. So again, I'll try to be basic in this. So let's say you or I have a primary resident and residence, and we leave. We have to be in that home 2 of the last 5 years, or we lose our one-time exclusionary tax. You don't get taxed for capital gains. So what's another reason for someone to do sub 2? Let's say someone left their house and they either rented it out or family used it, whatever. But now they've been gone approaching 3 years. That would mean 2 out of 5 that were in it, but it's approaching 3 years. If they don't transfer that title, i.e. sub 2, they're going to get whacked on capital gains when they sell it. So that's a very good tool to stop the clock ticking for that exclusionary capital gains issue. I don't know if I confused anyone on that one.
No, that makes you clear that perfectly. Now, let me
Okay.
ask you this question. If I'm a real estate agent, how do I identify some of these sellers? Or more importantly, how can I take a seller that may be in this situation that wants to sell, and how do I get them in touch with someone like yourself? Like what dynamic do I look for there?
So if I'm a realtor, I'm gonna do one of two things, and we have both. I'll give you examples. A realtor can either learn this. That if I knew this my first 18 years when I was doing realtor activities, I would have not left a lot of money on the table. B, helped a whole bunch of sellers out that I had to leave. Like when you're an agent, some stuff expires and some people can't get qualified. And C, I wouldn't have been on that treadmill of the one payday, right? We talked about that in the last show. So for all those reasons, now what should they do if they don't want to learn it? Because some people are very busy and they just want to run in their lane and they end up referring it to us. We have associates all over the country. We all over North America. So just reach out to us. You can email support and say, hey, I'm in XYZ state. I need someone to refer to on these deals. So you go in now as a realtor and you say, look, Mr. and Mrs. Seller, this doesn't look like it'll fit because you can't come out of pocket or whatever the reason is. I have one of my partners is an investor and they possibly could buy your home. Now you're an authority and you saved them.
Yep. And guys, if you need more detail on that, it's going to be on our YouTube channel at What's Your One More with the number 1 in the show notes. You can find the link to support on there, and you can also find the link to Chris's website to get started to gather this information, to decide whether or not you want to be an affiliate with them, or if you just want to turn it over to them as a referral as well. That'll all be in the show notes there on YouTube. So Chris, getting back to the subject too, one of the things I look at was, all right, so for me, I saw a property that was enticing, but it had been sitting for some time. And it was starting to cop a suntan, as I say. And I'm like, okay, what's going on with this property? I mean, it's been out there for 8 months. I mean, is it just in shambles? Is there other issues that you know about? And once we got to the heart of it, it was significantly overpriced, but more importantly, it needed work. I mean, you couldn't just move turnkey into this. You were going to have to put, a couple $100,000 in this commercial property to get it to the level that would have managed what we were looking for.
Sure.
To me, that was the first sign of a property that I thought I could structure, subject to on. Because it had been sitting, and we had a seller that obviously wanted to sell, but wasn't getting any types of contracts or any type of action there. Is that another way that you would identify an opportunity for subject to?
Yeah, anything different and outside the box. What you just described is one of many.
Okay.
Mobile home parks where banks that's not easily bankable. Anything that's not easily bankable.
Okay.
Or here's some quirky ones. Like if you call someone and then they're a seller, they're selling for sale by owner, and their voicemail's full, or they don't call it back, or they're rude, they're going to chase away most people. Okay. And that's a great one to follow up on. Then there's more, but that's just a teaser.
Yeah, those are great indicators right out the gate. You mentioned something earlier I want to circle back on, assumable mortgages. This is a big buzzword in our industry. Matter of fact, the VA stats that just came out showed that more assumable loans are being done now than they have over the last really 20 years. And so I think there's a couple of different reasons for that. One are the low interest rates that are available, and then 2, limited inventory, and 3, I think that the idea of, if I'm a first-time home buyer with rates the level they're at right now, my affordability is shrunk tremendously. And so I'm trying to find a way to get into that home. This may be an opportunity, especially with anyone in the service that's being transferred on orders. There's a lot of leeway there. However, before the show, you were extremely passionate about assumable mortgages and maybe why not to do them. And I would love to take a minute to explain a little bit of your thought process and add some stats from Black Knight in regards to this assumability option that may or may not be available.
Yeah, my reaction off here with you and I was just, the word assumable means you're going to apply for the loan just like a conventional loan. The only difference is you might capture a good rate. Okay, so there's a little advantage there. But instead, I would buy it sub 2. I would never bring up the word assumable. On occasion, and when I say on occasion, maybe 1 out of 50 or 100, a seller will say, "Oh, you mean you'll assume it?" And I say, "No. I'm not going to assume it. That's an application process and an underwriting process, and that process these days is awful.
Awful.
So no, I'm going to buy it. I'm going to act quickly because that might tie us up for 30 to 60 days, Mr. Seller. But I can act quickly and get this closed like as soon as we can do a title run, 7, 10 days." The loan will stay in your name until someday in the future I cash it out. That's it. I don't give it any more attention. You give it attention, then you're going to cause them to be concerned or ask more questions.
Yeah, and I think a lot of people forget on the assumability side, it sounds great. it's not that easy from a servicer standpoint. If I'm bank of, whatever, and I hold this VA loan for you, Chris, and you have a perfect payment history with me, why on earth do I want to go out and add risk to a loan I've already got a great pay history and relationship with by bringing in someone new that I can't guarantee is going to provide that same level of relationship? And so a lot of people kind of have this misnomer. The servicer is not required to grant the assumability by any means. And so just because the home's a VA, just because it has an assumable clause in the note, it doesn't mean the servicer is going to execute that. And to that point, Black Knight said there's about 7.2 million VA loans that have an assumable clause in them currently outstanding. Of those 7.2, only half of them have the equity position that makes sense for the assumability. And what I mean by that is most of those homes have over 6 figures of equity. So if you're going to assume a note, you, the buyer, are still responsible for the differential of that note. So just because you're getting that mortgage at 2.5%, 3%, you still got to bring $100,000 to the table. That defeats the whole purpose of a VA loan because you're trying to come with no money down. So I think there's this flawed logic on the VA side of things and what's happening there. And I think the ones that are getting done are those first-time home buyers that have money to bring to offset that differential, or maybe they're getting a seller held second on the backside. One of the two could be happening, but I don't know many sellers that have the ability to do that in this market right now with some of the financial conditions that we're in.
We should have addressed that. You brought up another good point because you brought up the down payment issue. Mm-hmm. When I'm buying sub 2, I'm not putting a down payment down. Now, because I'm not putting a down payment down, I'm probably going to have to pay the seller's transfer tax if the state has it. But you're talking a couple thousand or 3, 4, 5,000, depending on the price range, not tens of thousands like you were saying for a down. Second thing that's really neat for everybody to know is you literally can go on the VA site right now, and the VA site talks about allowing a sub 2, and they even explain, we would call it a wrap, they call it a mirror mortgage. It's on their website.
Right.
So it's like you should be talking to VAs all the time. Like you were explaining, the VAs getting service changes. We have that in our area in New England. So those are great seller avatars.
Yeah, and I think that a lot of people maybe underestimate what we're talking about from a subject to standpoint. What I love about this is you're really leveraging as an investor your cash flow, and you're leveraging, your basically down payment as well. It's not having to put a lot into it. And so I think one of the things that we talked about last show that I wanted to circle back on was when you do that subject to, you approach me, I essentially work with you, you inherit the note that I currently have, and then you turn around and that's now your payment. That's the payment that you're going to make on the house. But then you're looking, if I don't stay in that property, if I need to go somewhere, you're looking to put a renter in that property that you've already pre-qualified for that rent at a higher payment to make an additional overhead on that.
Yeah, we do. You can do rentals. We do rent to own 99% of the time. Yeah, we do segregate some and say, hey, let's keep that forever. But we do rent to own because I'm going to put a buyer in that house that is a true buyer. They just needed time to get qualified. So other than the 2 to 10% default rate we have, normally on the lower end of that, they're going to take care of the house like a buyer would. I'm not getting a landlord call, the toilet, the roof. I'm not getting that. That's why, Quinton, this is important to know. That's why during COVID, we went into COVID at our peak inventory without knowing it, 72 doors with all rent-to-own buyers in them, except for like 2, and only had 4 headaches the whole time. Why? Because they're not renter mentality, they're buyer mentality. And the fact that the government was letting people not pay does not affect their ability to buy that house. Does not help them with their option to buy that house. They have to stay current with us or they can't buy the house. Right. So a buyer behaves differently when there's trouble.
Yeah, and I think that's a really important distinction here is that you're operating with buyers, future homeowners, not renters. You're operating with someone with the intent to buy that home. That's the one they want. You have an agreed upon price. You have your own note with them, and you're becoming essentially the servicer of that loan for them. And you're telling them, you miss a payment, we've got problems, right? Just like you would, like you would with a traditional servicer. I think that's what I love about the company name Wicked Smart, because this is something that a lot of people have not considered. And when I've sat down with numerous investors post our show and explained this concept, it was like mind-blowing light went off. And I've been in real estate for going on my 23rd year, and I never had heard of this until you and I met. And, I felt like I was way behind the 8 ball on this. You guys had such a huge run up since 2008 on this and have been doing a great job with it. Perfected is what I would say. I just think it brings so much value to the show. So And I'm grateful for that. What I would love to do today is, a call to action for our audience. I would love for them to think about how they could implement this now. So could you give us, 3, 5 easy steps for someone to implement this? Even if it means pick up the phone and call on your team. But what would be those 3 to 5 steps that someone from this podcast could go, okay, starting the new year, I got goals. I want to own real estate. I want to be more of an investor.
Yeah.
Let's give it to them. What can we do?
Well, I would always say, and I think I may have said it in the last show, to connect with someone that is where you want to be. But so let's be biased, right? Because I'm here and say, okay, how can you do it with us?
Yes.
So I would do 2 things simultaneous because they're free.
Okay.
I would grab the free book. We have the link. We'll say it, and you can put it in the show notes. While that's on its way to you, don't wait. There's a free master's class. Just go to smartrealestatecoach.com/master's class. And if you can deal with listening to my speed of talk for another hour, you'll get a nice workshop. And then on YouTube, right? You can go on YouTube and watch, I don't know what the numbers, I've been using 250 for a while, but there's several hundred deals there posted showing you what we do and how we do it, the good and the challenging too. So you can learn from it.
Yep.
You'll know, you'll get done and go, yeah, this is for me, or it's not. Keep this in mind, just from a business standpoint. If you're looking to start something that's sort of healthy, energy-wise, you're helping not just your family, you're helping 2 other families when you do this. You're helping a seller that probably didn't have this pathway, and you're helping a buyer who probably lost hope because of the rates. You're helping 2 families every time you transact a deal. It's a super, super win-win-win.
Yeah, I think that's really
important. So that's the on-ramp. And then we have free stuff every week. I mean, we get together on Zoom every week at 4:00. We've been doing that since 2016. They're welcome to go that. So there's all kinds of things they can do. Just go to the website. You want me to give the link for the book?
Please, absolutely.
It's wickedsmartbooks.com/Harris. Simple. So we know it came from your tribe, and glad to honor that. You won't pay a dime for shipping or anything. We got it.
All right, guys, that'll also be in the YouTube link on there as well as in our show notes. Chris, I've given that book. You've sent me 5 copies. I gave all 5 out immediately. The most powerful person I gave it to was a site agent. She knows exactly who she is, and she owns 11 rental properties. Wow. And she had gotten to the conforming loan or the conforming limit. As we know, Fannie Mae, Freddie Mac says, hey, you can only have 10 financed. And this was the 11th one. She was trying to figure out, what am I going to pay one off? I got to do this. And she was already in the middle of the process. And I handed her that book. I said, read this book. This is going to unlock the next 10 to 11 for you without having to have Fannie Mae and Freddie Mac in the equation. And I know she read it, but I bet she was boom, mind blown again because of the subject to concept. She was like, oh my God, I could have done this on my quadplex, up north. And I mean, it was just interesting to see how, a lot of people are residential investors, but they forget that leverage is the key component to really amplifying, your asset pool. And so I think that you do a great job bringing that to the table.
No, thank you. We have in our contracts with our associates, I don't think I mentioned this on your show, we do have a clause that says, hey, if you get a property, because we revenue share. Mm-hmm. But if you get a property, we'll exclude one of your personal properties. So most of our associates come in and they have a rental and they go, hey, can you help me get this sold? We help them get it sold. We create the 3 paydays. We do all that. They learn from it and they don't give us 10 cents.
That's the best way to learn.
Yep, you bet.
Yeah, no, that's fantastic. Well, Chris, I know you're a busy man. You always bring so much value to this show here. I'm going to leave you with one lasting question because we get this all the time. We just did our crystal ball forecast for the rates. And I mean, my gosh, I get this question at least 5 times a day. I wish I knew the answer. I'd be a gazillionaire by now. But, when rates come down, and we know they're going to come down, it's just a matter of time. The timeline may be pushed down the road. How does that impact what you're doing? Because right now you're in the driver's seat because there's those lower rates out there. But as these rates start to come back down, does that alter your business, or does that go, hey, there's tons of opportunity when they come down? I want you to consider this. What outlook do you have?
Yeah, you could throw almost any criteria at me like that's market related or economy related, and I'd say doesn't matter in creative real estate. Now, we'll fish in different ponds as the market changes, right? Mm-hmm. In 2013, everyone told me you're nuts to buy. I aggressively said buy. In COVID, some people in my space literally closed their doors. I screamed, no, double down. People had huge success. So I'm telling you, when you understand how to pivot and can get resourceful, you're going to do that in up, down, or sideways markets, in up, down, or sideways rates, and up, down, or sideways anything, pricing anything.
Guys, I'm telling you what, you're listening to one of the best throughout the real estate industry right now that is doing things that other people are not doing and bringing it to the table. More importantly, it sounds based on his success. It's a recession-proof business due to the pivoting and the different ponds that you can go into. If you want to know more about this, if this is something you're interested in and you want to even further deeper dive, I encourage you to go to their website. The educational tutorial videos are absolutely on fire. I have watched quite a few, if not all of them. Chris, what's another way? What else would I direct this audience to go learn more to get a deeper dive besides YouTube and your website?
If they're on social, I'm not, but my son-in-law and those guys run that. But they can hit us on Instagram, Facebook. They'll see us on all the platforms. Just type in Smart Real Estate Coach.
Yeah, absolutely. Chris, hey, thank you again for your time. I greatly appreciate it. You came on here, killed it as usual. And for our audience, I hope you guys took away from this today. I hope you found something extremely valuable and got a little bit more definitive information on subject 2/sub 2. If you guys could 5-star review this podcast on Apple, specifically on Apple, leave comments. We'd greatly appreciate it. And then check us out on our socials at What's Your One More with the number 1. Till next time, Chris, thank you so much for being on the show. We'll see you back at What's Your One More.
Thanks, buddy.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.